Good morning, America. This is Ernesto Caleri. I am Josh Jelinski's wingman, and you're listening to The Financial Quarterback. It is the must-listen-to radio show for all things money, from tax savings, wealth management, retirement planning, and a little relevant dose of politics, just to put it all into perspective. This morning, we have a very special guest. It is Dr. Lacy Hunt. Dr. Hunt is the author of 2 books and numerous articles in leading magazines and periodicals, including Barron's, The Wall Street Journal, The New York Times, The Christian Science Monitor, and more. Dr. Hunt is also the executive vice president and chief economist at Hoisington Investment Management Company. He's made numerous presentations in all the major financial and economic centers in Europe and Asia, and he's appeared on radio and television outside of the United States, including the BBC, NHK, TV Tokyo, and he's testified before various committees of Congress, including the House Ways and Means Committee, the Senate Finance, and Senate Banking. So, good morning, Mr. Hunt. Dr. Hunt, can you hear me?
Good morning. I certainly can.
Great, fantastic. Would you give us, I know I gave you a nice little opener. I'm fascinated by your background. Would you give us a little more of your background, please?
Well, I received a PhD in economics from Temple University in January of 1929, in January of 1969. I went into the Federal Reserve at Dallas. At that time, William McChesney Martin was chairman of the Fed. And when I left the Dallas Fed to join Chase Econometrics, Arthur Burns was chairman. People don't really remember those names, but they were outstanding Fed leaders. I was an econometric model builder. Built a large, probably the first large-scale econometric model of the financial markets, credit markets. Chase Econometrics was a subsidiary of Chase Manhattan, and in those days, Chase Manhattan was run by David Rockefeller. And from there, I became the chief economist for the largest bank in Philadelphia. For 15 years, I was the chief U.S. economist for the HSBC Group, formerly the Hong Kong Shanghai Banking Corporation, which at the time was the largest bank in the world. And I've been with Hoisington Management now since 1996. I've received numerous awards, including the Abramson Award for my contributions to business economics. I've published in the scholarly journals such as the Journal of Finance, the Financial Analysts Journal. I served for 23 years on the board of trustees at Temple University, and I'm an honorary life trustee of the board at Temple. I received their distinguished alumni award in 2018. My undergraduate college, Sewanee, awarded me an honorary doctorate of civil laws in 2013, and then they recognized me as their distinguished alumni in 2016. So, been around a long time, seen a lot of things, and I really enjoy economics.
You have one of those backgrounds where, thank goodness, it's one of the professions where age and wisdom is actually appreciated. In your background, you've worked with David Rockefeller at Chase and then Sir William Purvis at HSBC. Can you give us some insight what it was like to work with those 2 great titans?
Well, it was a wonderful experience. I was in the econometric subsidiary of Chase Manhattan. I was their director of monetary economics, and I was producing forecast with an econometric model for about 100 financial variables. And it was David Rockefeller who first invited me to attend the Asset Liability Committee meeting of the old Chase Manhattan and I had an opportunity to do a few projects for him. And it was a very great experience to be in the presence of such a man. And, it was very important. In the course of my time at the Federal Reserve, I served with the major macroeconomists from all of the Federal Reserve, regional banks, as well as the Board of Governors and the New York Fed. I did the training program for regional bank economists at the New York Fed. While I was doing the training program, I actually lived at the New York Hilton for about 5 weeks. Took the subway down to the Fed in the Wall Street area, and I served on 2 Federal Reserve System committees: the System Committee on Financial Analysis and the System Committee on International Analysis. One of my professors at Temple had said to me that I was going to have to embrace international economics and finance. And this, keep in mind, this was in the 1960s. And the professor said that we're going global and you're going to have to do it. And that was one of the things that proved very beneficial to me, because I was equally able to operate with domestic macro and global macro. And that's where I've worked, and that's where I've concentrated my entire career.
Wonderful. Well, good morning. This is Josh Jelinski, the financial quarterback, and Dr. Lacy Hunt is joining us. It's interesting to learn about that. So good question, Ernesto. So you recently did an interview for Real Vision where you talked about a disinflationary stew. The question that we always ask is deflation or inflation. Apparently, you think we're at a disinflation. Describe that a little bit. I mean, I'm worried about, a lot of people are worried about hyperinflation right now, with lumber being 150%, real estate going up. Enlighten us, Dr. Hunt.
Yes, I have a very lonely view, Josh. One of the reasons I think that people think we're going into inflation is that we're going to have very rapid economic growth this year. And in real per capita terms, the economy will probably grow the fastest since the early 1980s, possibly even since the late 1950s. However, I think the inflation rate is still going to come down. I can give you several reasons. First of all, inflation is a lagging indicator. That's the way it's classified by the National Bureau of Economic Research. Between the start of the recession and the low point in the inflation rate, the gap is almost 4 years. If the inflation rate were to start rising at the beginning of the recovery, it would start building imbalances into the system. And so it's a lagging indicator. Another consideration is that after very deep recessions, such as we had last year, there's been a very strong recovery in productivity. We saw this after the deep recessions of 1949, 1958, the deep recessions of the early 1980s. And in all 3 of those cases, the productivity gain was so large that unit labor costs were unchanged. Another consideration is the pandemic itself. The pandemic disrupted supply chains, and the low-cost producers of goods in Asia were not able to move their product into the United States. And as a consequence, the high-cost producers in the U.S. were able to increase their market share. In fact, the pandemic did more for domestic producers than the tariff increases that were instituted by the prior administration. And so now we have a situation where the low-cost producers in Asia's market share has been reduced. The market share of our domestic higher-cost producers has been raised. And the low-cost Asian producers are going to want to try to hold market share. Our domestic producers whose fortunes have been changed as a result of the quirks of the pandemic will try to hold. And we will see price wars on a lot of goods.
So price wars meaning prices will keep going up, or eventually they'll start going down?
No, they'll be cut. Prices will be cut to regain market share.
So if I'm looking to buy a house, hold off. Wait a couple years. The disinflationary stew may be upon us. So Dr. Lacy Hunt, one of our all-time favorite guests, going to be talking about inflation versus deflation, what he sees as economic headwinds on the horizon when we return. And folks, head over to the YouTube channel, search for The Financial Quarterback, and you'll find us. And give us a call, 888-988-JOSH, if you want the retirement reality check. It's a 45-minute strategy session with me, Josh Jelinski, the financial quarterback, and more when we return with your questions at 800-321-0710. Don't touch that dial.
The preceding program was sponsored by the Jelinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.